doing well at this point in time, and we are waiting for the markets to open to get a clear handle on how much of this will be where the market is willing to put its money, where the pre-opening rates are. There isn't any sectoral trend that we can gather. Banking generally has done well because the deposit growth, especially for banks like PNB, was good, but PNB, I don't know, it's starting in the red. Pre-open at least, it looked like good numbers to me. Well, there goes the bell, and red is the color. Not very, very deep red, but just a tad lower, 18 to 50 points lower. As far as the Sensex is concerned, it's about 130 lower now. Okay, so it has gone below the 79,800 mark. And the Nifty still, of course, well above 24,000, but it's given up 24,200. Now we are just angling at 24,150 levels. Midcap's a bit in the green, and the Nifty Bank as well a bit in the red. So still it would count as flat terrain. ONGC is the leader of the pack. People seeing value after that steep fall that we have seen in the stock. Trent, M&M, HCL Tech, SBI Life, HUL, JSW Steel. So really it's an FMCG day and a bit of metals day as well. What's not doing well? Hero Moto getting punished for the numbers not being very impressive. Hindalco not joining the metals pack, it's not doing too well. Wipro, Bajaj Auto getting punished for the third day in a row after the numbers didn't impress. And then there's Infosys, TCS, ID stocks generally, I think, in the shadow of what we saw in the US in the Nasdaq giving up gains, probably. That's a bit of a struggle. Midcap,
the stock of the morning, Avenue Supermarts. Yep. The stock is up close to 10% or thereabouts. Big move is what we're seeing on that one. Just take a look at that stock. Flying away, volumes as well, very, very high. And now it's locked a temporary circuit up close to around 10%. Giving it company on the upside is a smaller name, V2 Retail. Keep in mind the stock is up more than 3x in the last 1 year or so. But the street likes that operational update, and that's why that's up as well, close to around 5%. V-Mart Retail as well, volumes relatively lower out there, but that as well is up close to around 3%. So these retail-oriented stocks have done very, very well, and they are the big movers this morning. Avenue, V2 Retail, as well as V-Mart. Pull up a few more names. Bank of Maharashtra, that's up close to around 4%. The street likes that update that they put out there. Because crude oil prices have moved up, Oil India as well as ONGC, both of them have moved up as well. MOIL, remember the stock has corrected close to around 35% from the recent peak. Well, the operational update, at least for the past quarter, was good. So that's why that stock as well is up close to around 4.5% or thereabouts. So good going for some of these names. What's not doing well? Well, at the start of trade, you have a couple of stocks that are under some pressure. I think, J-Corp continues to remain under some pressure, so that's a little bit lower as we speak. 63 Moons is another one that's down close to around 3% or thereabouts. So we should keep an eye out on that one as well. So the headline index is a little bit low. But what's done very, very well this morning is the Midcap index, and that's up close to around 0.3%. Vocart as well, positive news flow. So that's up close to around 6.5%. And Axis Gates, there was a resignation of one of their top executives. But yesterday the stock was up 5%. Today as well, it's up close to around 5%. So it looks like the street is sensing something else with regard to this particular countdown.
Absolutely. And so, you got all told about 30-point downtick on the Nifty. And I think the Nifty Bank is down about, they're all flat right now. I mean, 7-point change, that's it. IT, the index is down about 0.25%. Remember, IT services will be the first off the block with earnings. So we'll get a sense of what that is like. But it really is a little scattered. DMart is limit up for now. I mean, 10%. So 39.72 on DMart. Remember, with DMart, the big, in a way, talking point over the last 2 quarters at least was the implications of quick commerce and whether DMart is falling behind because in the regular habit of stocking up for the month perhaps is taking a bit of a backseat because you can order as you go.
So should we call this Empire Strikes Back?
I don't know, but yeah, I mean DMart definitely is doing well. The second biggest volume-led gainer is Transrail. It's a recent listing, I think 3%. Yes. It's got humongous volumes for this point in the day, so we'll keep an eye out on this one. Sundaram Finance is up 2%. It's all small in terms of price change after that. Amber is up about 2% or so. About 7,700 on Amber. Rights is up about 3%. IRFC. I mean, so some of these railway proxy names, 2.5 higher there. Bank of Maharashtra, we highlighted 4% on BOM. Walkard, Nigel mentioned, it was up 6. It's up 8.5 now. 1568 on Walkard, just one way. I mean, 2024 was a fantastic year. and 25 is starting in pretty good style as well. The other one is Sagility, which is again a recent listing. I mean, about 3 weeks old, 4% higher, 52. Another recent listing is Premier Energy, 2% up, 1353 on Premier Energy. What else? Z is up 4%. Car Trade is up about 3.5%. Quest Corp is up about 4%. But then, volumes trail off if I go down the list and look at some of the other names as well. The biggest volume-led loser right now is Hero, which is down about 2% or so at this point in time. Again, not very much volume-led activity on the downside to show for it. So 20 points lower is what you have. Pankaj Murarka is with us. He's our Market Master of the Day, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, good morning. Happy New Year. Great to have you with us on the program at CNBC-TV18. And it's always good to speak to you.
Morning, Prashant. Wish you a very happy New Year.
Thanks very much, Pankaj. So how are you feeling about 25? Optimistic, a little cautious? I was saying in the morning that despite, at 25, especially the last few months kind of soured returns a little bit. But, we're coming off a pretty good run, right? I mean, last three years or so have been pretty decent. Actually pretty good, especially if you look at individual stock returns. What's your sense as we begin this new year?
For a bull like me, it's always very difficult to be bearish on markets. But having said that, I think it's wise to start the year on a cautious note, because the fact remains that while India is a high growth economy, the fact is that we are the most expensive market in the world, and probably the economy is in the middle of a cyclical slowdown. So I think what I really think is probably this year is going to be a year of stock picking. We'll see a probably much more wider dispersion between sectors and stocks. And probably stock picking will make a difference. Probably at the index level, I think probably we'll have a slow start to this year, because I think last quarter's earnings were not so great. And our belief from whatever we have seen from our conversation with companies, probably this quarter we'll see some uptick in earnings, but that uptick will still be fairly modest probably. So I think our assessment is probably this year, as we start this year, first half of this year is going to be a slightly more gradual recovery in the economy, and probably we see recovery in the economy in the second half of the year. So the first half of this calendar year will be more benign in that sense. And I think stock picking will play a bigger role in terms of driving returns. And yet I still think that probably this year could be similar to last year in terms of aggregate returns, where index could do a high single digit kind of returns, which is not bad in a matured bull market like the one we have, because we're already 5 years into this bull market.
Okay. Yeah, but we are also about 8% off the highs that we saw in September. Pankaj, good morning. And again, Happy New Year from me as well. I wanted to know, we all sang this theme of urban slowdown, consumption slowdown. But look at the way Avenue Supermart, V-Mart and all have reported the December sales numbers. Does it look like, at least in pockets, people have been able to beat the slowdown? Are you positive on retail itself?
We are positive on certain specific names in or companies in. I think some of these companies doing well is more about these companies having a very strong or excellent execution. But I think overall consumption is slow, meaning it's about 6 quarters now that we have a rural slowdown, where rural consumption has slowed down. And we've seen signs of urban has also slowed down in the last 2 quarters. We are seeing some pickup that has happened in the festival season, but that's very modest. Some of these companies, let's say like DMart doing well, I think is more about exceptional execution by these companies than more. I would not extend this trend to the sector or to the consumption overall at the aggregate level. So I still think
some FMCG companies actually told us rural recovery, when they spoke to us after the Q2 numbers. Some of them did speak that rural recovery, and they were all bemoaning urban slowdown, actually.
Yeah, Lata, but the thing is, we have to see it in context. The recovery from a very low base, and it's a very modest recovery. It's been about 6 quarters that from the time rural consumption started slowing down. So from a very low base, still the recovery you're seeing is low single-digit recovery in terms of volumes. Large part of recovery for these companies is in terms of value, because they've taken significant price hikes. So even in this quarter, when we look at the consumer numbers as we anticipate going forward, meaning most of these companies will report probably mid single digit kind of revenue growth, and within that also a significant part of that growth is coming from price hikes than volume growth in that sense. So the volume outlook or the recovery is still very benign or modest from a very low base. Meaning, our view still is that probably we are in an investment-driven cycle. So in this, it has been the case in the last 3 years, and we believe over the next 5 years, India's growth will be led by investment. So investment-driven companies or sectors will actually outperform consumption, which is exactly opposite of what we had in a decade prior to COVID.
Okay. Hi, Pankaj. Good morning. Good to see you in. This is Nigel on this side. You know, Pankaj, when we spoke, I think somewhere in September, October, I recall you telling us that I think you all had a fair bit of exposure to IT and you all were quite positive in the medium term. Now, that played out perfectly. You know, stocks like Infosys, I think Birlasoft, you know, various other names that you all had, they have done quite well. How much of this good news is in the price? Because there are still some kind of headwinds, though the street is looking forward to a much better showing in FY26. So what's your current view on tech and what do you like from there? If you could name a few companies alone.
Morning, Nigel. You have a very sharp memory, I must say. So the view on IT still holds, Nigel. Yeah, probably, I think from a near-term perspective, the returns in IT have got front-loaded in that sense, and markets already pricing in FY26 earnings or valuations in that sense. But our view on IT is slightly more medium-term, where we think probably while we'll see in the over the next 3 quarters, we'll see a cyclical recovery in IT spend, but we still think that from medium-term perspective, the growth will accelerate for IT. So yes, from the near-term perspective, the returns have got front-loaded, but we still like some of the large-cap names like Tech Mahindra and Infosys, and we like specific names in mid-caps like Persistent, Coforge, and some of the other small-cap names as well. So we continue to remain overweight on IT as a sector overall.
Okay. All right, Pankaj, we'll leave it there. Thank you very much for joining us, and here's to many more conversations through the course of the year in 2025. Appreciate it. Mark Mobius is now joining us. He's chairman at Mobius Emerging Opportunities Fund. Mark, great to see you in the new year, 2025. This is Prashant here. Happy New Year to you, your family, your team. It's always sort of great to get you for our viewers on CNBC-TV18.
Thank you very much. Happy New Year to you. I'm now in Australia, appropriately on the Gold Coast. So I hope that everybody will end up with a lot of gold at the end of the year.
Absolutely. That's well put. And we're looking forward with hopeful kind of views here. Mark, so let's begin the conversation set us up in terms of what your sort of bigger, broad, top-down thoughts are. Is this going to be a slightly tougher? You've been a big bull on India through 2023, 24. But I think towards the end, you moderated that view a little bit, if I'm not wrong. How are things looking, especially sort of EMs and, of course, India then specifically as a market?
Well, of course, as you know, the Indian rupee has gotten weaker against the U.S. dollar. And that's a factor for U.S. investors. They have to look at that factor, what the impact on their portfolios will be. But I think the rupee value of the index will more than make up for these devaluation of the rupee against the US dollar. And I think going forward, you're going to see a very good market in India. And India, I believe, is going to benefit from the Trump administration simply because, first of all, the Trump administration will not favor the Chinese market. And if you look at the global picture, where else can investors go overseas? Where are the best places? And India comes up all the time because of the incredible growth of the country, because of the reforms that are taking place under the current government, and simply because there's so much value in the market. Companies with very high return on capital, etc. So I'm continuing to be optimistic about India generally.
Okay. Good morning, Mark. I think it's good afternoon for you in Australia. Thank you again for joining us, and a Happy New Year. Does US exceptionalism continue, and for how long do you think? Because even if India has its positives, it's just such a big magnet when the currency is strong. Yields over there are 4.5%, and the IT stocks are, they've given over 20% gains no matter which index you pick. So when do you see that exceptionalism peaking off or even waning?
Well, first of all, you must remember, if a country is growing at 6, 7, 8%, whatever number you want to pick, companies will be growing at double at the rate. Good companies that have a high return on capital will be growing at double that rate. So you're talking about 14, 15, even 20%. So an increase in price of 20% more than accommodates the kind of increase in value that you have in these stocks. So I don't think we should be too worried about the fact that many of these stocks have gone up so much. They will continue to go up if these earnings continue to go in the direction that we've seen them. The other factor I think is very important, and that is for those companies that are exporting, let's say Infosys that exports a lot of software, they are going to become more competitive because of the weakening rupee. So I think you've got to look at many of these stocks that have a US dollar income component will continue to do very, very good. And I think we're on this cusp of more exports coming out of India, not only in the software area, but also in manufacturing.
Mm-hmm. Hi, Mark. Good morning and good to see you in. This is Nigel on this side. You know, Mark, besides being born in the 1980s, I missed out the entire Reaganomics that everyone talks about. It's supposed to be a golden period for the US economy as well as, everything did well out there. Now people are looking forward to Trumponomics 2.0 and they believe it's going to be as good. What's your view? You know, given this sort of a backdrop, this sort of expectations, what would your allocation be? I recall a few months ago, you were saying if you had $100, 50% would come to India, some to China, and that did bounce. But currently, if you had $100, what would it be?
Well, the 50% number is still, pretty much on the mark of what I would like to see. Of course, when you're doing a portfolio that has to be diversified, you can't put that much in one portfolio, but it'll certainly be 20, 30% in that range. But my personal desire is to be 50% in India. Now, let's look at the Trump administration. What is going to happen? First of all, Trump is going to lower taxes. Secondly, he's going to cut out a lot of the bureaucracy and a lot of the paperwork, a lot of the impediments to doing business in America. This is going to be very, very good, not only for American industry, but for foreign industries. Because you must remember, if you cut out a lot of this bureaucracy, it'll be easier for Indian companies to do business in America. So this is going to be a big boost, not only for the US, but for the world. And by the way, I think there's also going to be a demonstration effect where countries around the world look at the US, see the way the bureaucracy is being cut, see the way that the budget is being saved from the wasteful spending, and they're going to think, hey, maybe we should be doing that as well. So it's going to be a very, very interesting development going forward. And I think India stands to benefit probably more than any other country in the world because they are the natural choice after China for manufacturing. And of course, the reforms that are taking place under Modi are having a big, big impact and will do, it's going to be a very, very, very good partnership that India will have with the US.
Okay. That's good to hear that, Mark. But what will you prefer in India? There is also a domestic pain point in terms of urban consumption slowing. We saw it in the FMCG company numbers, microfinance loans defaults, and the latest December numbers for two-wheelers also are not very heartening. So which part of India do you buy?
Well, first of all, I would look at export-oriented companies to begin with because of the currency situation, and also simply because India is gradually becoming more and more competitive against the Chinese exporters. That's number one. But also, you must remember that India continues to have a per capita income rise. So I'm not writing off the consumer-oriented industries, which includes housing, it includes consumer products, et cetera, because you've got an incredible value. When I travel around the world, I see more and more Indian tourists coming in. here in Australia, I was just in Sydney, they were full of Indian tourists. Of course, India itself, my trip here last year through India, I was having to wait in line because there's so many Indian tourists. What does that mean? It means more and more Indians have disposable income to spend on tourism, on products, et cetera, et cetera. This is an enormous change that's going to take place. And it's going to put actually a lot of pressure on companies to meet the demand that's coming down the road.
No, I completely agree with that, Mark. And that's a longer term trend which hopefully will keep rising. Maybe in the very short term, since we just finished the holiday season, is perhaps also is because some are saying that some of the Southeast Asian countries, and there's been a lot of debates online on social media, etc. It's much cheaper to travel there as compared to taking a holiday within India to some of the sort of favored destinations.
Yes.
So, Mark, just another thing. I don't know if you saw this entire controversy around H-1B. These are visas for skilled foreign workers to come and work in the US. I mean, IT services companies in India have used that for the last 25 years to send sort of Indians abroad, right, to work on projects, etc. Now, it's not just H-1B, but I mean, at least on social media, etc., from the so-called MAGA supporters, Make America Great Again, the core supporters of President Trump, right? There's been a lot of almost, I mean, and I use that word carefully, pushback, hate about sort of outsiders, and this time directed especially towards Indian workers taking up well-paying American jobs. Mr. Trump was asked that question on H-1B on the eve of New Year's, and thankfully he's kind of saying that we need highly skilled people in the US. But that's, in a way, the core base kind of sort of sounding this off in this way. Do you think, is there any risk at all? Not just H-1B, but generally attitude towards, foreign workers and jobs and that kind of thing?
Well, if you look at the statements by Elon Musk and by Mr. Ramaswamy, who, as you know, was a presidential candidate and with an Indian background, they're both saying that students graduating from universities in the US who are from India should automatically be given a green card. And I think Trump will implement that going forward because they realize that they've got to hold these very intelligent Indian students who are now becoming very capable professionals. I mean, if you look at Silicon Valley, look at how many people of Indian backgrounds, actually with Indian citizenship, are running the big tech companies in California. And I think that's going to hold true in other parts of the states. So I think the administration realized the value of the brain power that India has and will want to hang on to these people. But by the way, there's a benefit to India as well, not only because these Indians will be sending money back to India, but more importantly, they're going to obtain experience in the US and education from the US and bring that back to India because India is going to become much and more competitive in terms of offering these people good earnings. So it's going to be a win-win, I think, for these students in America. And I think it's going to be very interesting going forward. But I, for one, I'm quite optimistic about these students living and working in America.
All right. No, absolutely. And I hope that is exactly how that turns out. I think, Nigel, you have a question?
Yeah, just one more. Mark, you spoke about export-oriented themes, and there's been one stock that you have spoken to us for the last few times you've conversed as well, which is Persistent Systems. Anything new you've added in terms of, a couple of stocks, if you could name for us? I think 360, one WAM, that was another one. If you could tell us recent additions, a few stocks that you'll have in your portfolio, which you'll believe that has a longer runway?
Well, as you know, Persistent has continued to do quite well. And I think other stocks that we have in India are all doing quite well. But I believe that going forward, what I want to look at is companies that have an orientation towards the semiconductor industry. Unfortunately, we have not yet been able to isolate such companies, but we're going to look at those very carefully because I believe India is going to become a big competitor in not only low-end IT and low-end computer chips, but high-end as well. So I believe that's one sector that I want to look at more carefully. I can't give you any specific names at this stage because we're looking at that, but that's something we want to keep an eye on.
Okay, point taken. I think that will be the big story of the decade, probably. Mark Mobius, it's always a pleasure having you with us, and thank you very much for helping us inaugurate 2025 with your presence.
I just want to say 88 years young, right? I mean,
thank you very much.
Mark, it's always great to speak with you, and I just want to add that because I just hope that
you won't believe the way you speak that it's 88.
We have your energy and enthusiasm when we are your age. So thank you very much.
Absolutely.
Well, by the way, I wish you would all read my new book, The Book of Wealth, which talks not only about wealth but about health as well. So thank you very much.
Can't be more timely. Can't be more timely, that advice. Thank you very much.
Yes.
And coming from the right person.
Absolutely.
Thank you.
Okay, touch wood anyway. Touch wood. We have to take a break on that note. But coming up is another very important conversation. We're going to connect with the creme de la creme of Kotak Group. Shanti Ekambaram from the Kotak Mahindra Bank, Sanjeev Prasad of Kotak Institutional Equities, and Srini Srinivasan of Kotak Alternate Asset Management. The team is going to talk to us about their outlook for the Indian economy, banking system, deposit costs, earnings growth, how will equities do, all that coming up. Stay tuned. Welcome back, and we are kicking off 2025 with one of our favorite themes or shows, the Brain Trust shows. And today we have the Brain Trust of the Kotak Group. As I told you, we have with us Shanti Ekambaram, Deputy Managing Director at Kotak Mahindra Bank, Sanjeev Prasad, Managing Director and Co-Head at Kotak Institutional Equities, and Srini Srinivasan, Managing Director at Kotak Alternate Asset Managers. Gentlemen and Shanti, thank you very much. And from all of us here in the newsroom and working behind cameras, a very happy new year to all of you, your families and everyone at Kotak. Okay, let me start with perhaps my favorite, banking. Shanti, first to you. How do you see the banking sector? Do you think that the war for deposits that we saw continues? Changing of the calendar, tearing that page is not going to make a big difference. We're going to continue to see pressure on liquidity, pressure on raising deposits, pressure on margins. Will that be the theme, at least in the first half?
So, Lata, if I take the last 2 quarters or even 3 quarters so far, you've seen deposit rates have been reasonably stable. You've not seen them sort of spike or have a runaway as far as the deposit rates are concerned. 2 factors to it. I think the system liquidity was fairly reasonable. And 2, it is a fact that there has been some moderation on the credit side as well. So banks have been able to raise deposit, but the cost of deposit that you asked and the rates have been reasonably stable. And I expect as we get into 2025, this will continue. Ultimately, it is a demand-supply ratio. Right now, it seems reasonably balanced. We have to see how economic growth happens, how demand for credit takes off, which we have seen some moderation in, and that will determine the trajectory of deposit rates. As I see it right now, stable.
stable. So margins could continue to be under pressure, or that pressure is off?
So it's like this. Margins are a function of your lending and your cost of funding.
Yes,
It is not just the cost of deposit. It's also the mix of your lending, right? And I think if you look at an industry level, the mix of unsecured retail has come down. The mix of SME and some amount of corporate has come up. But banks will devise ways to see how they can sort of keep their names reasonably stable. So expect some stability and maybe some marginal reduction at the industry level on NIMs.
Okay. Point taken. I'll come back to you on this unsecured bit, which has become a theme in itself. But before that, Sanjeev, to you, I mean, I read your 2025 note, and you have been worried about urban consumption and the general slowdown. Does the December auto sales kind of ameliorate the picture a bit? After all, we did see the small car come back in the Maruti sales numbers. So perhaps the urban consumption slowdown is not all that bad and things are plateauing, no?
Lata, we'll have to wait and see, because it's obviously only 1 month that we have seen this number. Also keep in mind the fact that if you look at two-wheeler sales, numbers have been very, very bad actually. This looks like somewhere about low teens kind of a decline in numbers. So if you look at Bajaj Auto, was down 19%, Hero was down about 17%, which is quite surprising. Having said that, December is not a very big month for auto sales, so obviously there will be a lot of variation depending on what happened in the base month. On Maruti specifically, the hatchback segment volumes are very low in December 2023, somewhere about 2,600 units only. And that was something like a 74% decline from the December 22 month. So I don't know whether I need to really get excited about this big increase. We have seen almost 12% increase in volumes in December 24 versus December 23, or I need to look at the fact that December 24 versus December 22 is actually still a decline. So I would rather wait and see how volumes play out over the next few months before taking a more decisive view on this point. Having said that, the commentary from companies, whatever pre-result, releases have come out, seems to suggest that at least things are getting better compared to September quarter. September quarter was a complete washout. If you recollect, whether it was rural, urban, everything looked very, very bad. At least this time around, you saw the press release from DMart. At least looks like, some recovery seems to be there. Again, we'll have to wait and see whether this is for real, how long it sustains, and so on and so forth. But at least as of now, things seem to be better than the September quarter.
So what are your earnings growth expectations for FY25 and 26? I mean, either Nifty or your universe.
Yeah. So for Nifty, if you look at it, it's going to be very bad year for 2025. It's only 4.5% growth. But keep that in the context of the fact that you had very high numbers of BPCL in the previous year. You had some accounting change in Coal India, which boosted its numbers in FY 2024. So if you strip that aside, that is remove BPCL and coal from the base, then you are looking at somewhere about 10% growth for the Nifty 50 for 2025. For 2026, as of now, we have about 16% growth, both on a reported basis, including BPCL and coal. And even without those two companies, also it seems like a similar 16% kind of a number. Obviously, we'll have to wait and see whether we see some money downward as we go through the year, because that's been a typical situation, right? And every year we start somewhat on the higher side, and then numbers start coming down. So as of now, we could be in a golden period of earnings, in the sense, people have stopped bothering about 2025 numbers. Even if they're downwards, people don't care. But people have still not, started to cut 2026 numbers. Hopefully that would be the case, but, let's see. I'm reasonably okay with 26 numbers forecast for now, given the fact that a lot of growth is actually coming from, banks, IT, etc., where we are a lot more comfortable with our earnings forecasts.
Okay, fair point. No, I'm sure Prashant also and Nigel have a lot of questions on specific sectors and stocks. But first question to you, Srini. This IPO, actually, people made a lot of money. There was a money control story which actually did the calculation. I think about 60% are still trading at a premium. So does the Diwali in IPO continue, and investors will make money, you think?
Well, I think, if you look at the liquidity in the market, and as Sanjeev was mentioning earlier, people are discounting further and further out and ignoring the numbers for the short term. What we are also seeing is that there are new categories of companies which are coming into the market and the inclusion of companies like Zomato in the index just tells you that the composition of how the market will look like over the next couple of years is changing. So all of these new service-oriented companies or the new age companies, those which have achieved scale and who are now showing a trajectory of bringing down their burn, obviously having a positive rub-off effect on all other industries as well. So once people make money in the IPO market, the party will last as long as some other disaster doesn't strike. And right now we don't see a disaster around the corner, so maybe it will continue.
Okay, well, Shanti, let me come to the core problem that banks have faced. Up until 2013-15, we used to think of banks as lending to corporates, but that NPA blow-up made everyone come to retail. Otherwise, you used to think, HDFC Bank, ICICI Bank gave some retail loans. But now all PSU banks and then fintechs, everyone is only retail. And that explains why perhaps now we are starting to see over-lending, unsecured loan problems, MFI loan problems. How do you see that getting resolved? Do you think corporates are back in the game? And specifically for Kotak itself, do you think the unsecured issue is behind?
So let's look at the industry level. If you look at banks, Lata, they were always diversified. You had, corporate, what I call commercial credit, as well as retail credit. Commercial credit is really, including commercial vehicles, tractors, agriculture, and the like, etc. So when the demand for loan, you also have to look at where the demand for credit has come in the last 5 years, particularly post-COVID. Post-COVID, you saw the demand surge from consumption, urban consumption, exactly what you mentioned, that you're seeing some plateauing effect. This saw a surge, whether it was buying a property, whether it's buying cars, whether it is lifestyle, whether it's credit cards, etc. We saw a huge surge. So wherever there was an opportunity, I think banks and NBFCs and fintech, right? So banks, I would say, have a reasonably diversified portfolio. If you just talk about us, our unsecured retail is now just marginally below 10%, around 10%. So banks have a diversified retail portfolio. Retail, corporate, commercial. I think what you have to see is some of the fintech players focused only on the unsecured retail, and some of the smaller NBFCs moved towards that. So I think much has been said and written on it. You had the RBI warning, but if you actually see the growth in the last 2 quarters, and I was reading the RBI numbers, etc., it has come off in a big way at an industry level, right? From over 30-35% to now almost 10-15%. So I think that's where it is. As far as corporate is concerned, are you seeing very big capex happening? No. But I think you do see certain sector investments, whether it's renewable energy, whether it's data centers, whether it's adding to capacity, which I call brownfield. So some amount of capex is happening. There's a lot happening in the mid-market and the SME sector where they are building for capacity. So I think there is opportunity across all the 3 segments. Retail has led the surge because of the consumption. As consumption, moderates, as we see. I wouldn't call it this thing as plateaus. You will see an equal focus across. And ultimately, it depends upon what rates, because it has to be win.
Absolutely. Good morning to all 3 of you, and wishing all 3 of you a very happy new year. Prashant this side. Sanjeev, if I can come to you, Shanti mentioned data centers, renewables. I mean, I'm just taking off that and sort of building on that. We've discussed and you've illustrated with the specific examples on power as a sector, some of the absurd valuations at which stocks are trading at. But it's a space, you're smiling, and we've had this conversation many times in the past. But in 25, Sanjeev, is it, since earnings growth is going to be tough to come by, will even slower earnings growth get stocks to move? I mean, 10% plus kind of earnings growth, will it be enough? And which areas you think, Sanjeev, where you think one can still find opportunities?
If you go by valuations, and that's where the struggle really starts. It's not as if we are debating the growth prospects of the economy. I mean, we are still looking at 6% for next financial year, inflation coming down. So the macroeconomic fundamentals seem to be in reasonably good shape, I would say. The challenges are henceforth. The first is the starting point of valuations. Valuations have stayed high, despite the fact that you had a pretty stagnant market, I would say, for the last 6 months. What has happened, unfortunately, we have seen a lot of earning downgrades in some of the consumption-related sectors, which means the valuations have not really come up. Most of the, if you look at the consumer staple names, most of them are north of 45p even now, despite very, very abysmal top line and bottom line growth as of now. So obviously, investors are still hoping that at some point in time you will see some recovery in rural demand, urban consumption, and so on and so forth. But the signs are still challenging, I would say. So consumption for me is ruled out for the time being, very expensive with not so great fundamentals. If you look at the investment part of the market, slightly more exciting stuff happening over there. Actually, the investment cycle is doing quite okay. If I look at government capex, I think 2026 should see a big recovery compared to 2025. For the simple reason, 2025, the government simply did not have enough time to spend the money. The first 4 months spent in elections, formation of government, and so on and so forth. Capex number is down 12% in the first 8 months. And the government space seems to be in decent shape. So hopefully 26, we will see a decent recovery in capex. Thankfully, residential real estate demand continues to do pretty well. And that's one part we are still quite positive about. If you look at the outsourcing sector, which is IT and pharmaceuticals, we are okay on both. Obviously, both benefit from weaker currency and so on and so forth. We'll have to wait and see if any of the policies of the incoming administration in the US are positive or negative. Hopefully, neutral to positive. Let's see, how things pan out. Valuations are high over there. If you look at the pharmaceutical sector, stock gone up a lot in the last 6-9 months. But I can live with that. At least the company are showing pretty decent top line growth as also bottom line growth. Which brings us back to the banks and NBFCs, where valuations are very reasonable. Shanti talked about some of the issues over there. But I don't know whether, that's enough to result in the kind of punishment we have seen for the banks in general over the last 2-3 years. A lot of derating has happened. And assuming that you don't see further, bad news on the NPL side, at least, most of the banks are doing now 13-15% ROE, whether it's a PSU bank or a private bank, most are in that range. So I am hoping for, ROE-linked return for the banks in general. I'm ruling out any re-rating for the time being. If we get a rating also on top of that, well and good. But as long as the book is growing at ROE, and that's the return to expect, I would assume, for the banking sector. So that's how I would summarize our positioning on the market for now.
Okay. Well, Srini, can you round up how private equity might work? After all, the US is a big magnet now with dollar and rates in favor of US exceptionalism. Will money come in? And, actually, you all have been filling the gap which banks are lending to corporates. Private credit is lending, but Reserve Bank warned that, the NBFC connect with private credit can mean that some of the loans are just getting, bad loans are just getting kicked. The can is getting kicked. So just tell us, will it be a good year of private credit? Will Indian alternate assets find more takers?
Well, I think if you see, there are 3 parts to it. You started the question with private equity. I think most of the private equity folks are focused on getting exits, and new allocations are hard to come by. First of all, on account of the LPs not getting enough money back, and India is the only exception, really speaking, where people are able to get exits, and sizable exits at that, thanks to the public equity markets that's been doing very well. On the private credit side, I think Shanti and Sanjeev alluded to that earlier in terms of credit growth. A lot of the credit growth is happening on, infrastructure, in renewables, and some of the newer sectors where maybe some of the banks are a little wary of, having large extension. And we are seeing some structured transactions that we can put capital out to. And many of the private credit market players right now, which is now getting a little crowded because while capital was not available globally because of attractive US dollar returns for US investors, a lot of capital is being raised from the domestic market. So what I do see going forward is that while the private credit market will continue to grow at a healthy clip, there could be situations perhaps 2 or 3 quarters down the road where excess capital or some kind of mispricing of risk is likely to happen perhaps in the September, December quarter of this year. So while private credit is going to be a good place to be putting your capital to work, you just have to be careful in terms of who you put the capital to work with. I think the other thing that we see a very significant positive coming out of where we are is, I think Sanjeev alluded to residential real estate. We also see very significant opportunity from an investor point of view on the office asset class. There isn't enough build of office space going on, and the global capital centers are actually ramping up capacity utilization. And that means that you are going to have reasonably tight office markets. And those who are in Mumbai already know that rents have shot up significantly and not enough supply coming in right now. So I would say all in all, it will be a year in which you should be possibly thinking of allocation to non-equity assets at this point in time, be that credit or hard assets, and there will be pockets of opportunity. Government and asset owners of infrastructure assets will have to recycle their assets, which means sell stabilized assets to build new assets. And the new bids on solar, for example, which are actually more attractive than actually buying an existing solar platform. So there is going to be a fair amount of churn in terms of solar platforms being available for sale. So it's going to be interesting opportunities to earn good annuity risk-adjusted returns, as well as when you have the appetite for higher risk to get into high-yield credit strategies. So overall, while capital raising is still going to be a challenge, so one is going to be relying more on the domestic capital base to raise even alternative capital as opposed to international capital. That's the way I would sort of sum it up.
Okay, that's an excellent wrap of a very vast topic. Thank you very much, Srini, Sanjeev and Shanti. Unfortunately, out of time, not out of questions, but we do hope all of you and everyone at Kotak have a brilliant 2025. Well, that's the word coming in from the Kotak Group. Cautious, optimistic, but cautious.
Absolutely. And, we'll have more opinion over the next few days as we sort of, really get started and get into 2025. Well, that was an interesting chat. Mitesh is back with us, 10 o'clock. And what are trades looking like? We're down about 120 on the Nifty, 24,066. Mitesh?
See, I think my belief was that we'll get a dip to buy into around 100 points, and we're right there. So I think this is the time to explore long positions. I have, in fact, two buy calls. One is Canara Bank, which is a buy with a stop at 101 for targets of 108. And the other one is a buy on ONGC, which is doing very well in this weak market as well. I buy here with a stop at about 249 and look for a target of 265.
Okay. All right. Two buys, Canada and ONGC. Mitesh, thank you very much for that. We're going to take a quick commercial break here. We'll come back and there's a special conversation lined up with Anchit Nair of Nykaa Beauty. He joins in to discuss their outlook for Nykaa, outlook for the beauty business in 2025, coming up after a quick break. Okay, welcome back. About 100 points lower, which means there is some amount of recovery, which is visible. We were down 130 when we took that last break, and we're down about 85 now. 24,100 or so is where we are trading at. Market breadth is positive. So broader markets doing just fine. 1,700 stocks are higher. You got about 700 stocks which are lower at this point. So comfortably positive. Nykaa Beauty is, as promised, the next company we're speaking with. The management is joining us now. As per Nykaa Trends report, the international brands are growing 1.5 times faster than average. But there is a recent BofA note as well, which suggests that the apparel industry growth is likely to remain a little subdued in the near term. Competition for Nykaa with the competition coming in from players like Shein, etc., entering the market also perhaps to be noted. We have Anchit Nair, Executive Director and CEO at Nykaa Beauty, joining us here in our studios. Anchit, great to have you with us here on the program. Thank you very much. Happy New Year.
Yeah, to everybody.
So, report with Consumer Insights about how 2024 has panned out was fascinating to read. But I want to just sort of ask you a more open-ended question before specifics. What stood out to you in that sense? I mean, what piece of consumer insight? Because that is, what kind of products they ordered, when they ordered, and, what's the peak time for ordering and all those kind of things. But what to you was a big surprise when you look back at that data?
See, I think for me, the biggest thing has been to see what our goal was when we got into this business really playing out nicely. And that was to drive the adoption of beauty as a category in the country. When we started this business, beauty in India was a very, very niche industry, and there was hardly much consumption. And even today, I mean, if you look at it, India has some of the lowest BPC, beauty and personal care consumption, anywhere in the world on a per capita basis. So we're still very early in our journey as a country. But given the kind of GDP growth that the country is seeing, the kind of middle class that is growing, and the amount of aspiration, especially in smaller towns, we think that it bodes very well for discretionary categories like beauty for many years to come. So what we're enjoying is we're seeing that a lot of the work we do to build the category, we're a demand generation platform. We see ourselves as category creators. And a lot of the work we've done over the years is starting to bear fruit. And I think in the report, you'll see a couple of those things really playing out. One, of course, has been the increasing sophistication of consumption. And you can see that in multiple ways. One has been the phenomenal growth of international brands, both Korean brands as well as European and even Japanese brands doing phenomenally well on the platform, as you also mentioned, growing faster than the platform average. Second thing has been the kind of sophisticated ingredients that consumers are now engaging with, especially on the skincare side. So search volumes for things like alpha-arbutin, retinol, niacinamide are growing leaps and bounds. And it's showing you that the Indian consumer is developing a certain level of awareness for this category. And Nykaa plays a big role in that. I think the third big trend, which I've been interested in seeing play out, is the growth in tier 2, tier 3 towns. So, some of our highest ticket sizes are now coming from cities like Faridabad and Ludhiana and Chandigarh. And we've been big proponents in building beauty for all of India, and not just focusing on a couple of key metros, but really taking beauty to every city and town in the country. So if you look at it, we even opened 50 plus stores in 36 cities this year, taking our total store count to over 220. And we opened stores this year in cities like Agartala, as well as Siliguri. So you're really seeing that beauty is being democratized in India, and Nykaa has, of course, played a very big role in driving that democratization. So we're seeing that whether it's tier 1, tier 2, tier 3, consumption is starting to look a lot more similar, regardless of where
not
you
just
live.
men, but not just women, but men as well.
Of course, yes. I think why not?
And I think we're going to get to some of those questions there in just a bit. I just want to, before my colleagues also come in, how is quick commerce sort of impacting? Is it impacting the business? And what are your thoughts really on how beauty products are delivered? I mean, the 10-minute urge is visible here in this category as well, because, I mean, some of the international brands, some of the luxury brands, those are higher margin products as well. I mean, the experience also matters, right? How you shop. Quick commerce largely is still, it's more commodity in that sense. Just your thoughts, Anchit.
See, look, I think you're right. See, for us, we see ourselves as a category creator. We need to generate demand so that we can benefit from that for many years to come. I think quick commerce, of course, is solving for a consumer need that seems to be present in the metros. And However, it's not really a demand generation platform. It's basically helping to meet demand that already exists. But someone has to create the demand. And you look at a category like beauty, with the lowest per capita consumption anywhere in the world, there is still a lot of work that players like Nykaa and some of our key global brand partners need to do to make beauty into the category, into a size and scale that the category is in many other markets. So demand generation is very, very important, and that is the work of players like us. And we do that through content, we do that through education, we do that through having, as I said, 250 stores in the country. We have a B2B business that is distributing 150 brands to 250,000 retailers across 1,000 plus cities. And of course, we've got over 35 million monthly active unique visitors on the Nykaa app itself. We've got 30 million plus transacting users. So it is, we look at addressing the entire market as a whole and not trying to just find certain opportunities. So we want to take India with us on this journey. We want to build this category. And of course, speed is very important, and maybe you saw this in our note, but today 70% of all of our orders in the top 110 cities, not just the top 10 cities, top 110 cities are being delivered within the next day. Beauty is a very long tail category as well. We have over 150,000 SKUs that are actively being bought on the platform. And for anybody who's shopped color cosmetics, you know that there's multiple shades, there are multiple different products, and each consumer has a different requirement. So yes, we continue to improve our speed because I think that is incredibly important, because e-commerce has always been about convenience, and speed is one aspect of convenience. But the other aspect of convenience is also being able to get whatever you want, wherever you want. And I'll give you an example. We delivered a face wash within 10 minutes in Mumbai, because we've been doing a Nykaa now. We ourselves are doing our own rapid delivery, which we've also spoken about in the past.
It must have been 4 in the morning on Sunday, yaar.
I don't know. Yeah, maybe you're right. I haven't looked at the time of the order, but we did a face wash order in 10 minutes in Bombay. But equally importantly, we also shipped a lipstick 2,800 kilometers to Srinagar. Because there is demand. That is also convenience. For the consumer sitting in smaller cities, the ability to get access to whatever product they want and to not be curtailed by whatever is being offered to them basis whatever inventory management planning needs to be done. I think that's also equally important, especially for players like us who are looking to drive the creation of this market for many years to come.
All right. Hi, Anshit, and good to have you in the studio. Well, Anshit, a quick question out here. Y'all are also trying to keep up speed, and as you said, y'all are focusing on this faster delivery. But that's something that could hit profitability. What's your comment on that? And also, there is this talk about discounts as well as pressure on pricing. Is that likely to continue for the near future?
Yeah, so I think I can't comment on too near of the future, but look, what I can say is that...
how far are we from the end of this price war, so to call it?
The price war has been getting better. I would say that, India is a tale of two markets. Of course, there are value-sensitive consumers, there are price-sensitive consumers, but there are also consumers who are looking for what we say as high-quality products at the right price. And I think Nykaa has always focused on, we want to give the best the world has to offer, but at the right price. Because then consumers are actually making the purchase for the right reason. Sometimes when everything is about price, then consumers will actually end up with the wrong product because it's incentivized by whatever the price of the product is. And we don't think that's long-term demand creation and generation.
Yeah.
So I think that, and also a lot of our brand partners, they spend so much time and effort to build beautiful brands and beautiful products, and the kind of R&D that they do, the kind of efficacious products that they come out with, these products, the stories need to be told. And we don't want to commoditize the beauty business. I think you saw some other categories in India get very commoditized by heavy discounting. And we've stayed away from that. We as a retailer don't do retailer-funded discounting. We're happy to pass whatever offers our brand partners would like to offer the consumer. We're happy to pass those on. But we want consumers to buy the right product for the right reason. And our brand partners appreciate that because we're helping them build brand equity, which will help them for the long term.
All right. And we're being warned that we have overstayed on this topic. But very quickly, there's so much talk of urban consumption slowdown. You noticed any of it?
See, again, as I said, quarter on quarter, there could be variability in terms of what demand is being achieved based on multiple factors, whether it be inflation or it be other such things. But I think we have to remember that India as a country, the GDP has reached a certain level where consumer discretionary categories will start to see a lot of tailwinds. And as that GDP per capita continues to improve, which we're all expecting it to do, and with such an aspirational population, in fact, this is the first time when there are more women, I think, in higher education than men. So especially for discretionary categories that are female-focused like ours, I think there's many, many years of market penetration and demand generation yet to come.
Oh, absolutely. You owe us another longer conversation. We owe you another longer conversation.
Thank you, Archit.
Thank you very much for helping us celebrate 2025 in style.
Great way to start the year. Thank you.
Yes, for us, certainly. Thank you very much. Okay, we have to take a quick break and we're going to continue with this New Year-related themes. Joining us now after the break is Puneet Chatwal of Indian Hotels Company to discuss how the holiday season and the tourist season that was has panned out for the Indian hotel industry. Welcome back. We are celebrating the birth of the new year and the holiday season that's coming to an end. And who better to take us through how good it was in business terms other than Puneet Chatwal, Managing Director and CEO of Indian Hotels Company. Mr. Chatwal, good morning and thank you very much for joining us. From all of us at CNBC-TV18, a very happy 2025 to you, your family and everyone at Indian Hotels.
Thank you. Happy New Year to all of you.
Okay. Well, the first thing I wanted to ask you is actually, well, a little negative because there were, I believe you're joining us from Goa, and some news reports from Goa newspapers told us that the beaches were not so crowded. Is it that Goa is getting bypassed? Was the holiday season not as up to the mark as we all expected?
I don't know about the entire market. I have seen a statement from the Tourism Minister of Goa, which says in the newspaper today that the year has been very strong. And for us, we have almost 50 outlets in Goa, including homestays, and we are trending ahead of last year. So I don't see any reason of any slowdown. But yes, there has been a chatter about it. I heard that a month or 6 weeks ago. And, you know, we have to take the year as 365 days and not just like 10, 15 days here or there. The start in December was relatively slow compared to last year, but the pickup in the run from 20th of December to 31st of December was phenomenal.
Oh, okay. Then that kind of puts paid to any such fears that perhaps Goa didn't come up to the mark. But more generally, I wanted to ask you, we had this advantage of revenge tourism, which has obviously taken your stock over the 1 lakh crore market cap mark as well. You were the best beneficiary of that revenge tourism. Is it continuing or has it begun to fade?
I would like to start the year on a positive note. Firstly, I think we benefited a lot from our not like-for-like growth. Just in the calendar year, we signed almost 80 new agreements, which is, 1.7 agreements a week. That means we added so many more hotels to the pipeline. We opened almost 40. And I would like to say that, yes, there was some kind of a travel upsurge post-COVID. But more importantly, this is coming through the change in the demand and supply scenario. The demand is stronger than supply, and the demand is stronger than supply because of the change in the infrastructure in the country, because of what you just now had on your channel, is the change in the GDP growth of the country, is the change in the disposable income. And, when I just look at the next quarter, we have several government delegations, heads of states coming in the months of January, February. You have the Aero Show in Bangalore, you have the new event happening for the first time in India called The Waves in the first week of February. There's the Mahakumbh, and that spiritual tourism will start from 13th or 14th of this month, ending with Mahashivratri towards the end of February. So there is a lot happening on all sources of demand, whether it's business, with waves happening in Bharat Mandapam. I always said, if we get one big event every quarter in Bharat Mandapam and Yashobhumi in Delhi, the upsurge in the demand will be significant. And the same is very important for the wedding. Year 2025 is going to have higher wedding dates than we've had in the last few years. So all in all, I think we remain very optimistic, and only one place where the sector is lagging behind is foreign tourist arrivals in India. And with our very energetic tourism minister, I also remain optimistic on that front that we will put some right levers in place to increase those arrivals and get to that 100 million target, what we have set for by 2047.
Oh, yes. As well, I wanted to speak about your targets as well. Doubling the number of hotels, if I remember right. That's what you said on your Capital Markets Day, 350 to 700, correct? That was what I remember reading in your report. Well, I'll come to that in just a bit. But let me take up this. This is a very interesting theme you've put on the table. In terms of foreign tourists, even a few, say, 10 years ago when you went to Colaba, you saw this mix of so many nationalities. Now you see less of foreign tourists over there. We seem to be missing out to what? Vietnam? Is it to Thailand, to Bangkok? We're missing out, we're losing out to somebody. Will Indian Hotels plan to put hotels there in Vietnam, in Bangkok?
Well, Lada, the action is here. These are small niche markets. They are important. Whenever any opportunity arises, we will try to benefit from it. But our focus in using our time and capital and resources stays on the Indian subcontinent. There is so much happening in tier 3 cities. We have discussed on so many occasions. We are building, a lot of new markets, including islands of Lakshadweep or a lot of new markets in the Northeast. So I think spiritual destinations, we just opened a hotel in Puri. We opened a few days ago the airport Taj at Kochi. So I think a lot is happening on all fronts, and I'm very excited. I've always mentioned this about the growth of the ginger brand. This is a part of our new businesses, and new businesses are doing a top line growth of 30-35% plus, and that's what we have guided the market. And it will only increase. It's not going to slow down because of the change in the business model, the change in the brandscape, and the change in India itself, which is driving.
No, I take your point entirely. I think you all put that word spiritual tourism on the table after the Ayodhya temple inauguration. So I mean, that's absolutely a whole new vertical for your industry. And likewise, as you have told us several times in the past about ginger being a new concept, and especially, I guess, very margin accretive for Indian hotels. If you can give us some ideas, which will be the growth drivers? Will it be these new concepts like Ama or branded residences? Will it be spiritual tourism? Which is the big growth driver that you see in the year and years ahead? I mean, I know you won't talk about the quarter, you're in silent period, but for the longer term.
The big growth driver in the next 5 years will remain our great crown jewel, which is the Taj brand. And the growth in Taj brand has been phenomenal. We've done a lot of upgrades, a lot of repositionings, and we expect Taj to remain like almost 70% of the portfolio in the next 2 to 3 years. But the new businesses will keep increasing their share to get to 20-25%. And that is very critical to us because we are addressing the needs and wants of all kinds of customers in a heterogeneous country like India and not just focused on luxury. Luxury with Taj was, is, and remains iconic, which has helped Taj to become India's strongest brand and world's strongest hotel brand. And we want to maintain that position like we've been doing for the last 4 or 5 years. So obviously there is no replacement for Taj, but Taj has been around for 121 years. Some of these names may be old, but they're really new startups. And the reimagined gateway has nothing to do with the gateway of the past. But the name was good, the idea was good, and we just fine-tuned it and reimagined and relaunched it like we did with Ginger. So I think all in all, we expect these new brands to scale up very fast, and these will be the key contributors in the doubling of the portfolio by 2030. We are not going to build a Taj in every nook and corner of India. The market has to be able to sustain the cost base, the capital structure that a Taj kind of a branding needs.
Okay. Oh, well, I have lots more questions. Unfortunately, out of time on the show. We'll take a rain check. We will speak with you after your quarterly numbers when you'll be perhaps more relaxed about speaking about things. Thank you very much, Puneet Chhatwal, for joining us, and once again, a great 2025 to you. And I take your point, more Tajes and more Gingers. And I think what is helping both Indian hotels and India is that more people think that Taj is affordable, that it is within their reach. That category itself is growing. And there's, of course, a new category growing and capturing the Ginger luxury as well.
Just the last word, the sector is going to write a new narrative for India in its contribution to GDP and job growth. There is no second thought in my mind about that.
What a great way to end the conversation, and what a great way to start 2025. Thank you very much, Puneet Chhatwal. We have to wrap up on that note on Bazaar. A break. Chartbusters will take the market action forward.